After 6 straight days of gains, the S&P 500 finally took a breather today, but don't be fooled by the modest red on the surface. Underneath the surface, we saw a pretty strong rotation continuing to unfold. Defensive sectors like staples, utilities, healthcare led the market once again, while tech and energy faded. Meanwhile, hard assets took the spotlight. Gold jumped 2%, nearly 2%. Silver surged over 2%. And even Bitcoin climbed more than 1%. So the dollar slipping helped propel that. Long-term bonds dropped. The 10-year yield ticked slightly higher. But perhaps most interesting is small caps actually closed in the green. So a little bit of outperformance that we haven't seen in a little bit of time. And today's market outlook will break down what this intermarket action is telling us, where sector leadership is heading next, and I'll walk you through a bullish long call vertical setup in a stock that's benefiting from this defensive rotation. So let's go ahead and get started. Today is Tuesday, May the 20th, 2025. This is the market outlook from marketscholars.com. My name is David Settle. Before we get going too far, I invite you to subscribe to our YouTube channel. This icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at marketscholars.com for free. Follow me on Twitter for more content between the videos, and join our Market Outlook Facebook group that we've created. If you're watching on our blog, make sure you check out some of these other things over here on the right, including our Market Outlook live videos, where I take a look at old Market Outlook trades, see whether we should stay in them or get out of them. We also put on today's trade already before the market closed. Just click this image or come up to the top and hit under Market Outlook, go to Market Outlook Live. You can also sign up for our daily newsletter with this form, or click up here, click this subscribe button at the top. You can see there's today's video. You can also see a little recap, a written recap of everything that happened here today in the markets. Come down to the bottom, click this heart. It opens up this tab. Hit that like button that pops up there. Same thing here. Click this thumbs up icon. It opens up this tab, and you'll hit that like button there. There's the like button on this. And then you can see the like button that pops up down here at the bottom. The more you do that, it helps get our content out to all of our followers on these platforms. So thank you to those who do that day in and day out. Those who don't, you can do it right now while you're watching with one or two really easy clicks. All right, let's start off taking a look at the S&P 500 with the market forecast indicator. So you can see the S&P finished down about 0.4%. Still well above the moving average. The body technically would be called a Harami pattern, though that's not where the body today was inside the body of yesterday. Though it'd be a weak Harami pattern. The Haramis get bigger. They get stronger as a reversal pattern the bigger the first candle is, the bigger the body is. That's not very big body. Yesterday was a small range. Today was even smaller, 43 points, way below the average, way below the average, but below half the average. So a pretty big drop. It did bring the near-term line down, so the near-term line finished below the 80th percentile, so out of overbought territory, but it's actually still in bullish territory. So it's not, the momentum line dropped, but it's still at neutral levels between 40 and 60. So, I mean, it's not that big of a decline as much as we did fall there. So I wouldn't put a whole lot of stock into that. The intermediate line remains at the 99th percentile. We are still, in the 92nd percentile in terms of being above the moving average. It's almost 7%. So you saw the green dots, right? Those are really, really significant move there, still to the upside. And this is hardly a pullback at all. I mean, yes, the near-term line's down, but you don't get a near-term pullback until you're out of bullish territory. And obviously that's not the case right now. If I were to take a look at the NASDAQ 100, again, you can see we got a cluster yesterday. The S&P got a cluster on Friday. The NASDAQ got the cluster yesterday. And it had a little bit of a near-term drop, and that's it. Like, still not very much of one at all. The near-term line for the NASDAQ 100 is actually still in the upper reversal zone. The momentum line's down, but it is also still at bullish levels too. And we're getting closer to the moving average, but still at 9%. That represents the 91st percentile for the past year. So still getting a green dot there. So again, still represents just how strong this move has been, despite a little bit of weakness here today. If I take a look at the Dow Jones Industrial Average, same thing. Near-term line, momentum line dropping, but near-term line still in the reversal zone, coming off of a cluster. The momentum line in bearish territory, but not too. So this is probably the worst one. with the near-term line down there, but that's still not too bad. We're still in the 95th percentile in terms of being up above the moving average. And then finally, your Russell 2000, which actually gained today, so really an outperformer. That didn't stop its near-term line from dropping out of bearish territory after getting a little bit of what would be a bearish near-term divergence, but again, very weak near-term divergence, because while these are obviously lower highs, it's hardly a higher high up here. I mean, you can't really tell the difference there. So when you can't tell the difference, then that just shows how weak the pattern is. So again, market sentiment's rising on all of them. The intermediate lines in bullish territory, the upper reversal zone for all of them. The near-term line remains in bullish territory for all of these. So despite a little bit of softness today, the trend is clearly still bullish, and there's not even enough to even say. We can't even really say that today is like the start of a near-term decline, because I mean the entirety of today's range, as you can see here, finished inside of yesterday's range. So not really much of a decline whatsoever. If you take a look at some of these other asset classes, like the dollar index, again we're back to a bearish pattern, dark pink shading and a red line with the weakness today in the dollar, almost back below 100 again. The near-term line coming off a bearish peak, crossing back below the intermediate line, crossing into oversold levels, and momentum line dropping to extremely oversold levels. So a bearish pattern there for the dollar index. If I take a look at the 10-year yield, it still has a bullish pattern. Intermediate line still in the reversal zone. The near-term line coming off of a near-term low, getting into the upper half of the chart despite a drop in the momentum line. So we're not really going up very much because it's going to be capped here by the top end of the Fed funds range. But at least it's still up, right? It's still bullish there. Finally, if I take a look at like crude oil as a kind of a proxy for commodities. This is actually what's happening here right now overnight. It's up 2%, I guess, on some rumors that there might be an attack by Israel on different Iranian targets. And so that's actually tomorrow's candle that you're seeing there at May the 21st. This was today's candle, and you can see really not much of anything. Again, we got a bear tag, but we haven't built on the bear tag on either one of these really. The intermediate line's rising, but it's barely into bullish territory. Oops, I'll zoom out here. Near-term line's not very bullish. In fact, you could say we're potentially forming a bearish near-term decline. The momentum line's still below the near-term line, so not really a strong bullish pattern at all. And for all we know, by the time we open tomorrow, that this 2% gain will probably be gone. Considering, again, that's kind of what happens. We get these big moves, the overnight sessions, and they don't really hold. Let's take a quick look at Bitcoin. Still a strong pattern. Got a cluster today. So this is today's. Remember, this is tomorrow's pattern already on the futures contract. So we got a cluster today. The momentum, near-term line, intermediate line, all up above the 80th percentile. So the second cluster in the last couple of weeks, and you can see market sentiment's rising, and it's almost in the upper half of the chart. So we've had this good strong change in bullish sentiment. We've been able to maintain the change. A little bit of a near-term drop, but we bounce right back up, and we're still in this near-term rally. So still a really good move on this end of things. Also, sorry, I got something flying in my face here. If you take a look at gold, it's rebounding. So it got this bull tag, looking like we might turn a little bit bearish. We got dark pink shading because we dropped below the 50th percentile, but never did get the red line to go with it. So the rebound back up, and you can see, so again, this is today's candle getting back above the 30-day average, the intermediate line rising, strong near-term line, and this is going into tomorrow's candle here, which is still maintaining. So pretty strong move on gold and Bitcoin, maintaining strong bullish trends with the weakness in the dollar. And then commodities and crude oil, for that matter, and 10-year yield relatively flat today. If I were to take a look at the weekly chart, let's take a look at the weekly chart for the S&P. You can see, again, the golden cross that we've been talking about still has a pretty strong body. If you take a look, we are trading 14 points above this week's Hakunashi close. So that leads into a pretty good candle next week, potentially. Once we get below that, now we start to worry about what next week's candle in terms of a transition candle next week. But so far so good there. Pretty decent sized body, though it is smaller than the average of the last 3 bodies. So a little bit of weakness from that perspective. And we did get a higher high and a higher Hakunashi close so far. We still have the 3 green arrows on the MACD. We're still above a rising moving average. That's 1. We still have the MACD histogram positive. That's 2. And the stochastics is still, like the market forecast, up in the upper reversal zone. So all 3 of these are still showing 3 green arrows. When you take a look at the 2-line version of that chart, we're still easily above the 8-day moving average and still easily above the 17 for that matter as well. Remember, we're not really too concerned about any kind of decline until you at least break the 17-day moving average. And we're still pretty decently far above. In fact, the MACD or PPO of that gap between the current price and the 17 days finally dropped below its moving average. So the histogram is turning red. So a little bit of softness there in terms of losing momentum, but definitely not breaking the 17-day. And of course, when you go back, when you look at the regular, again, for us to be bearish, we'd have to be below this red line, the 17-day exponential moving average, and the MACD would have to be below its average, which it does look like, it's still above 2%, but it looks like it's getting closer as the average gets higher, well above 1.5, working its way up to that 1.75% level. Let's take a look at some of these other oscillators. Like the DMI, you can see the positive indicator still above 30, barely. The negative indicator still way below 20. So your ADX is rising above 20, hence the light green shading. Not very strongly, though, especially with that DMI dropping already, and considering that we're trying to have this parabolic move going on. We are below 70, but still above 60 on the RSI. So still bullish from that perspective, and you can see the CCI is also still above 0, so no change there. And then looking at the Ichimoku cloud, we have a mature trend, which is why any kind of near-term declines are so weak, because we have a very mature bullish trend right now, way up above the blue line. Like, we have to get below that blue line to start even considering potential weak, like this mature trend ending. We're way up above it. The rate of change is way positive. Well above the cloud, so clearly still pretty strongly bullish there. And then when I take a look at the Bollinger Bands and the Keltner channels, again, despite the weakness today, we're still above the upper Keltner channels. So even though momentum is so extreme and starting to wane a little bit, it's still pretty strong. Like, we're still, to be above the Keltner channels, it's still pretty strong momentum. So, as weak as we are, and the bandwidth is still really high, it's starting to drop. But still very strong there, and we're still in the upper quartile of that bandwidth. So there's still no again, while things are soft and there's a little bit of a rotation, we'll talk about here the safety trades. It's not showing in terms of in the broader market being weak. Like, the broader market is hardly weak at all. We did not get a new 4-week high point today, but you can see today's trading range again, completely inside yesterday's range, and so far the week's range is way smaller than last week's. Now it's a pretty small week, and you can see this range is just getting smaller and will continue to get smaller unless we get significant new highs, which doesn't seem to be the case, that we are going to get significant new highs. You saw the range, as small as it was, now is below 1.7%, so it's falling hard. The volume there pretty stagnant at relatively low levels as well. And then remember, the VIX is the thing we've been watching for, because we have 3 of the 4 things we need to be trending from a risk appetite standpoint. VIX below 20, below 90% relative to the VIX 3M, and then the VVIX we need to be below 90. Now, you'll notice, look, the correlation between the VIX and the VVIX has dropped below 50% now. And again, last time it got even close to 50%, you see the spark in volatility we had in December of 2024, and then we just kind of kept going from there. So yeah, we're not dropping. The 4th thing we need, besides the VIX also being below the 200-day moving average, the 4th thing we need is for the VIX to drop below 90 on the VVIX, to drop below 90, and that's just not happening. And again, the correlation is really struggling here because the VVIX has stayed elevated while the VIX itself is down. The VIX was down today. The market was down. The VIX was down. So this kind of just shows, despite the softness in the markets and the rotation, there's not a whole lot of concern. Right? There's a very high level, relatively speaking, of course, because it's still we're still barely below 20, but relative to where we've been on the VIX, there's a very, very high level of complacency that we haven't. Typically when we have this big of a drop, there's another kind of a bounce in volatility that we just haven't experienced yet. Whether we will or not remains to be seen. But the fast drop in the VVIX would suggest that there will be one coming, as well as the correlation falling as fast as it is relative to the VIX. Between the VIX and the VVIX, that correlation dropping as fast as it is also suggests that we're probably going to get another leg higher. Again, probably most likely, maybe 98% likely that we won't get a VIX jump above here on the next leg higher. But, we could probably get above 20 and up towards the mid-20s at least on any kind of rebound involved, even if it's a temporary rebound in volatility. All right, now let's take a look at what's driving this price action here. So you can see, let's just go to today first and see what the asset classes that move the most today. And look at that big jump in gold. Gold, this big move higher. And again, like as I showed you earlier, from the market forecast, it seems like it's rebounding. Let's take a look at this chart here, and you can see that as well. This is today's. Remember, this is tomorrow's candle. We're already back above all these moving averages. We were trading below the 17 and the 30. Well, we jumped the 8, 17, and the 30 all in the same day. The MACD histogram is turning back up, almost back above zero itself, almost back above its moving average, and then the histogram's almost, again, that's the histogram turns positive when the blue line crosses up above the orange line. So that was our biggest gainer on the day today. Commodities also had a little bit of a rebound, which is interesting because let's take a look at the commodity chart in general, the ETF that tracks the basket. It's a pretty good move. Again, still trading between moving averages, so not like a breakout type move, not like gold had. It is above its 8 and 17 day. They're both above the 30, so there is a small trend, but you're still below the value area, still below the 200 day. It's falling. But let's take a look at crude oil. See, crude oil didn't have that big of a jump. Again, not until the after hours when tomorrow's candle started. So crude oil actually is pretty flat. It's still above moving averages and still positive from the MACD and stochastics perspective, but still not above its highs that it had just last week. So interesting move there on commodities rising without crude oil per se on today's chart. Developed markets just continue to destroy everything else in its path right now. If you take a look here, let's go out to the ratio charts. Let's take a look at the ratio chart. And we'll take a look at EFA first relative to emerging markets. So here, let's do that. We'll do it on this chart here. We'll do that. And let's bring up EFA relative to EEM. And again, you can see the big jump we've had. A little bit of a pullback the last couple of days after this big trending move off the October low point. Big jump higher in the last, 4 days. Emerging EFA back above its moving averages. Again, this is the relative strength chart. Now, typically this is not very positively correlated with the S&P, but you can see the correlation is actually turning higher here. Emerging markets are more of the riskier aspect of so when developed markets are outpacing emerging markets, usually that's a sign of risk aversion, and very well could be the case here, especially again the last 4 days where there's been a clear move in risk aversion from a U.S. sector standpoint. But when you look at EFA relative to SPY, you can see there's also a pretty big rebound there today too. Last 2 days there's been a really big rebound in EFA relative to SPY. And again, that only generally happens when there's weakness in the S&P 500. So again, another sign of risk aversion typically, especially when you consider during most of the beginning of the year, including during most of the decline, all the way up to that April. Well, this was the April 8th low, but even past that, developed markets really outpaced the U.S. And then as the markets rallied, the S&P rallied too. But then the last couple of days, a big jump higher. So again, some signs of like risk. And then I showed you that before in terms of like when you look at growth versus value. That's not necessarily looking great over the last few days, including today. So 4 down days, even though we're still above the 8-day on this ratio, but still relatively weak. And then again, another one we look at is discretionary versus staple stocks. You can see down again today, the first filled-in body of all of the last 4 days, but 4 straight down days, still above its averages. So again, we're coming off of pretty strong levels on all these kind of risk appetite ratios. But one of those is being this, the relative strength of EFA is typically not a good sign for the markets. Especially you can see the markets were actually down on the day where EFA was outperforming so much. You can see long-term bonds. So even though the 10-year yield itself didn't move up very much, in fact, it was relatively flat here, but still at least above averages. TLT really dropped. Right? Remember, TLT is the 20 to 30 year, and still, look at the bearish trend on TLT. Still way below the 200-day moving average. The 8 and 17-day are falling below the 30. We're below the value area. The MACD and stochastics are at bearish levels. TLT continues to be on a strong bearish trend. So again, but that's actually a relatively good sign from a risk appetite standpoint. Except when you look, what you don't want to see is the correlation between TLT and stocks. You can see, which has generally been negative correlation. You want that the case, right? You want to see like the stocks are rising and bonds are falling, but to kind of keep that in perspective, that's actually a reflection of a deflationary environment more than, or a disinflationary environment more than an inflationary environment like we've been in. If I were to take a look at the 3-month version of this correlation, you can see it's pretty flat. Like there isn't a very strong trend between bonds and stocks, and you can see bonds are about to go on a seasonal pattern where this is the strongest next however many months. This is the strongest period for TLT typically this is typically the time of year where TLT sets the low point. Then it goes on a strong run all the way up through the end of August, where it seasonally has a big strong decline and retests the year low there in November before finishing higher. So TLT is about to get, which could impact yields. If TLT starts to go up, that would mean that yields are starting to show some weakness. And you remember, yields are sitting at the top end of the Fed funds range with very, very low odds. I think it's like 5% odds now for June for a rate cut. So very low odds. So that's what's keeping yields afloat. But if TLT starts to make a run, that probably means that yields start to falter. And again, as we just saw, that correlation, that relationship between yields and the S&P 500 is turning back to being positive again. And so if yields falter, then a good chance that stocks would falter too. If I were to switch this out to a 63-day period, you can see a relatively positive relationship over the 3 months, and very strong positive relationship over the past 2 weeks. Let's take a look at the sector rotation. I told you that the sector moves continue to show kind of a flight to safety, so to speak, in the last few days. Well, that continued to be the case here today. So if I were to take a look at May the 20th, you can see, again, staples, utilities, healthcare, your big 3 winners on the day, way outpacing everything else. And that's the 4th straight day of that being the case. If I were to go out 1, 2, 3, 4 to the 15th, you can see that, let's go to a 30-minute chart, that they have just been killing it over the past 4 days. They're up 4 to 5%, those 3 sectors, whereas XLK and XLY are actually down over that period. And again, when you look at that ratio of XLK relative to XLU, Again, kind of a sign of risk appetite. You can see it's very strongly positively correlated with risk appetite there. I mean, that's a pretty decent draw. Like, we had gone parabolic on the room up to the upside, very high PPO, very high CCI, very high RSI, but now we're clearly faltering here to the downside and breaking at least the 8-day, and we'll see if we ultimately break any more, because again, the last time we were this bullish and we started to break down below moving averages, that kind of started, in this case, just an intermediate decline, not the corrections over here, but this was at least an intermediate decline last summer at the end of July, going into the beginning of August there. That was when we went to Ghana, and the day I get back from Ghana was this day right here, August the 5th, when the market was like significantly lower. Let's take a look at the breadth and see how it's doing here. Remember, the breadth has been relatively strong. This is the first day in a while that we've dropped below 35. So this is the lowest. It's still positive, but the lowest breadth that we've seen in quite some time. Again, that's not surprising. At some point in time, you're going to show some weakness in that breadth, and you can see, again, the number of new highs has been relatively low because the market itself is still off of its highs, and you can see it's there right around the 84 number, so still below 100. The net new highs and lows are still hovering around 100, but at least slightly above it. So that's and above its own average there, which is now turned positive there at 53. The number of stocks above the 50-day moving average is sitting right there at the 80% mark, 396. Very, very strong move. But you also notice it doesn't stay above 80%, so we might be peaking right now in terms of the breadth, which with the number of stocks above the 200, failing to get above the 60% mark, and the number of stocks above the 50 sitting at the 80% mark, there's a good chance that this ratio is probably bottoming out itself. Now that can lead to a rally to the upside. If we get above the average, it can lead to a rally, but it can also lead to more volatility if that ends up being the case. If the number of stocks below the 50-day that are above their 50-day average start to drop significantly faster, instead of this when this started to go up here, it was because the number of stocks above the 200-day started to really take off at the end of last year. You can see that. I don't know if I've got that on the chart. That was actually at the end of 23 going into 24. Let me zoom out on this so we can see that as well. So the end of 23 going to 24, you can see it was the number of stocks above the 200-day that was taken off rapidly. So if this ratio goes up because of that reason, very positive. But if it goes up because the number of stocks above the 50-day is dropping instead, then then that's our concern, right? So it's really important that we, at the very least, stay above the 300 mark, but it's really important that we just don't drop back below. We're still way up above its 20-day average, but it's gone up so far so fast in such a small amount of time. We don't want to drop back below 300 just as quickly as you can see on some of these big moves, especially in 2022 when we moved up here to 380 even, and dropped back down pretty quickly. And the same thing in August. We got all the way up to a 90% mark. In fact, we were at 470 here, 460, excuse me, so well above 90%. And then we dropped right back below it, and we weren't able to sustain that strong bullish run in August, and we had another leg lower. So what we're trying to do is avoid another leg lower on this correction, right? Like there's low probability because it's so strong, this move that we've had. But we saw that in August, and we don't want to, we were the higher highs there too. We were well above the moving averages. I mean, it looks very similar now to then. So what we don't want to see is a breakdown, right? We want to see, instead of this breaking down, we want to see this really take off up to the upside and get above 300. And as you can see, once you get above that 300 mark, which is bullish territory for any oscillator, it's bounded between 0 and 100, but when it gets above that 300, then we're feeling pretty good about the strength of this new trend that we have. All right, well, that brings us to our trade idea of the day, and you can see here's all the trades that we've done in different videos, different markets. Some days where we didn't do a market outlook video, I still do the market outlook live, and we put on a trade for that day. We reviewed all of these already in today's market outlook live, and today's trade is actually on Dollar Tree. So let's take a look at the charts for Dollar Tree here. Let's start off with the market forecast chart. So we actually put on another trade similar to this in our directional option strategies class today. But Dollar Tree, you can see getting a cluster, which is not necessarily a bad sign when you're in a relatively new, especially kind of moving into gaps here. We've already filled in the one gap. We did that a while ago, but now we're filling in this gap all the way up to about the 94 level. Strong, market sentiments in bullish territory and rising. We're not in the 90th percentile, but we're pretty strongly above the moving average. So that's a very good sign. When you look at its long-term chart, we're just now getting a golden cross, so that's a good sign. Now that generally means when you get golden crosses, sometimes you get a little bit of weakness either before or right after the golden cross. So there might be a little bit of weakness here, but coming off such a significant low, especially with a little bit of divergence here, bullish divergence, that's a good sign from a long-term perspective that we're finally back up above zero. When you look at the 3 green arrows, obviously we have 3 green arrows, or at least we have the 2, sorry, we're close to the 3 green arrows. We're actually flirting with that today, at minus 0.01. I think it might have been 3 green arrows actually during the Market Outlook Live. But that's how close we are to getting it again. You can see the volume has actually been picking up the last couple of days, including today's big 4.5% gain there. Taking a look at the 2-line version of this chart, you can see we're above the 200-day moving average. We're above the value area. I mean, we're breaking into like no man's land from a volume standpoint. We dropped so fast over the past year. Now, if I were to zoom out to the past few years, there's a little bit more volume in this area, but still there's a pretty decent gap up to about the 105 level. Right about the 103, 105 level, plus or minus a few points. There's a pretty decent gap in volume because of how fast we dropped there that we've been filling in here. If I take a look at the DMI for it, DMI, you can see that we are above 30 on the positive indicator, well below 20 on the negative. The ADX is rising and almost above 25 itself, so a very strong trend developing. You'll see that as well in the Ichimoku cloud chart. You see this here, we're above 70 on the RSI, we're above 100 on the CCI, so good strong bullish trends there. Looking at the Ichimoku cloud, we're well above the cloud, strong rate of change, mature level bearish trend there. If I take a look at the DMI and the ADX, the Bollinger Bands, sorry, I wanted to take a look at the Bollinger Bands. If we take a look at the Bollinger Bands, you can see we're above the upper band today and the upper Keltner channel, so a good breakout move there. The bandwidth had been squeezing, so we're kind of, with the bands inside the Keltner channels barely for a day. Well, now we're back out of it today, right? So we're back to a green dot here today above all the lines. The Bollinger bandwidth is starting to rise again. So, opportunity for kind of a breakout trade. I told you, there's some, pretty clear sailing potentially until we get to that 103, 105 level. Well, then what we decided to do was sell the 100 strike on the long vertical, buy the 98. You can position size normally like we do for about $500 of risk. And you can see we got a pretty decent move, and we have a pretty decent go so far. We were kind of flirting with some gains and losses, so pretty good move here since we got into it, being up that 4.5%. I think we were only up a little bit less than 4% when I was looking at this in the Market Outlook Live. So an opportunity and a lot of flexibility in case there's any weakness in the next week or two. There's a lot of flexibility here that we can kind of meander around here, because you can see this gray bar starts to shrink, and we just want to keep our maximum gain inside this gray box, because the gray box represents a 1 standard deviation move. We don't want it to have to make an out of the ordinary move to get our maximum gain. So a lot of flexibility to work with in case things don't, in case there is a little bit of weakness here in the next week or two as we're making that long-term golden cross signal. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Join us at marketscholars.com for free. Follow and like us on Twitter and Facebook as well. Have a great rest of your Tuesday night, everybody, and we'll see you all tomorrow.